What is happening, guys and gals? Joe Badger here, your money mentor, where we have deep pockets and short arms, and where I help you with my nearly 40 years of experience with investing, business, and finance. We're going to talk about index funds today, the best ones for 2021. What exactly are they? Why should you be investing in index funds versus individual stocks? Well, we're going to talk about that, and we're also going to address the whole philosophy of beating the market. So I picked out some really good ones, some of the best ones that I think they've been around, they have a long-term track record, you're going to love them. Before we get into them, make sure you subscribe to the channel and also like this video. And we're going to get into the best index funds for 2021. Let's do it. So what is it about the index fund that is so good? Well, first of all, you have to understand what an index fund is. So it's basically a mutual fund, but it follows the particular index. An index is representational of the entire market. So the index fund approximates that index, follows along, and the whole idea behind that is it's passively managed. It's not actively managed like some high-performing mutual funds. And when you get a passively managed fund, you get a lot less fees, a lot less expenses, but you get that same return. You get that same performance over time. And since the general overall market goes up in the long term over time, hopefully you're going to get that performance. You're going to get positive gains, and you're going to make some money. The bottom line is, right? Now there's a whole idea of beating the market, doing better than the market, and we're going to address that as well too a little later. But where index funds really came from is a guy named John Bogle. Back in the day, he was the founder of Vanguard, and he invented these. And he wanted an everyday person invest into the market without having to be a genius when it comes to investing and finances, and without having to really hire the top-notch people in order to follow the complex market. So he invented these index funds, and a lot of people really like them. I like them. Here are 4 really good index funds that I think you're going to like. Originally, I just wanted to give everybody the top 3 index funds for 2021, but I decided to throw in a bonus number 4 too. So where to start? Let's start with number 1, and the best index fund as far as I'm concerned is FNCMX, FNCMX. That is the Fidelity NASDAQ Composite Index Fund. I know that's a mouthful, but basically it follows the NASDAQ index, which is the tech index. And if you've been paying attention to this, for the last 5 years roughly or so, tech has really been leading the way. So if you've had tech or this fund, you've really been doing good. It's a 5-star rated fund. That's a Morningstar 5-star. It has very low expenses. And another category when they're rating these funds is low returns versus high returns. This has a 4 out of 5 in the high returns. And that translates to, for the first year, the last year, 73.22% return. Excellent. And over 10 years, another excellent performance at 18% over 10 years. The expense is 0.29%. That's basically for every $1,000, they're charging you $2.90. It encompasses large growth companies. Excellent fund. I've invested in this myself several times over the last year and more. What I was doing is actually buying and selling it with the turbulent market in 2020. An excellent fund, and safe and strong, and a high earner, really good. They have a yearly dividend of $1.08. That was issued last December. So this particular one only has a whole has a whole year for you to get that, or it requires a whole year for you to get that yearly dividend. But once again, a really good fund, heavily tech, and it's run by Fidelity. It's been around for a long time. You can't go wrong with this one. Keep in mind that here's one stipulation though. As of the filming of this video, I've been noticing that tech has been going through a correction because they've been leading the last 5 years. So once this figures itself out in spring and summer, I'm guessing, then I think this is going to be a very strong fund going forward into 2021 and beyond. The next impressive index fund I affectionately called Schwab SCHB. In other words, Schwab, from Charles Schwab. So it is the Schwab US Broad Market ETF, a large blend equity ETF. Once again, a big mouthful. But Schwab basically follows the Dow Jones US Index. The Dow Jones is the big, large companies. In fact, this says that it includes the largest 2,500 companies. At least 90% of it does. So, once again, just a great performing index fund with a 0.03% expense ratio. That's very cheap. That's about as cheap as they come. There are some free funds out there, by the way, but super cheap. This one is a pretty big company, or I should say pretty big fund at $20 billion. That's decent, but you're going to see in the next one, it goes up to 225 billion, basically. So the past year, Schwab has performed 55%. Awesome. In the last 10 years, 13.78%, with a recent dividend of 0.28, or 0.28, so 28 cents. Star rating, 4 out of 5 from Morningstar. Excellent. You always want to be 4 or 5. And the reason I say 4 is because, I mean, sometimes some little tiny thing is bringing it down so that it's not a 5. But really, you look at performance, this could be really a 5-star rated fund. It holds a lot of the big stocks like Apple, Microsoft, Amazon. At least those are its top 3. And this has been around since 2009. And once again, just a really good example of a high-performing index fund that you really can't go wrong with. I want you to invest in VIDI. It's almost like FIDI, as in 50 cents. But this one's VIDI, VTI, which stands for the Vanguard Index Fund. It is a large blend equity ETF. So what this index fund basically does is it follows the whole market index. So that's US stocks or equities. When you hear them say equities, that just means stocks, interchangeable term. So this includes the large, the medium, small caps, and micro caps. So it's the entire market, the overall market. It approximates the entire index. Very low expense, once again, with a 0.03 expense ratio. Very large fund that really speaks to its longevity and its success, $224 billion. 4 out of 5 stars, excellent. The last year, 55.65%, and that's 52 weeks. And 10-year performance, 13.8%. Once again, an excellent fund from Vanguard. And the most recent dividend, 0.67. So once again, we have a Vanguard fund by one of the best companies out there. Vanguard Group was founded by John Bogle many years ago, and he really was a pioneer in the industry. And like I said earlier, he really wanted to simplify things for the common man and keep this a lot like I do in this channel here, really, is I'm trying to really keep things simple and easy while at the same time allowing us all to kind of participate. So John Bogle, he has since passed away just recently, really, 2019, I believe. And he had a really good book out too, and I wanted to recommend this book to you guys as a resource. And it is The Common Sense on Mutual Funds, back from 1999. And once again, he was a big proponent of mutual funds and index funds and following the market instead of trying to actually compete and beat the market. Guys and gals, can you say IWM? IWM? iShares Russell Index 2000 ETF, small blend ETF. So once again, a mouthful, but basically it follows the smaller cap stocks, that index, the Russell 2000 index. Now, what's really interesting is, just like I was saying earlier, how the tech was leading in the last 5 years or so, we haven't really seen a lot from the Russell index. And there's a lot of talk out there at this time that now is the time that they may have a resurgence. And so if that is correct, then this IWM, this index fund, is going to be very good and excellent. In the last 52 weeks, it has an 87.6% return. And in the last 10 years, 11.2%. 4 out of 5 star rating. It has a 0.19% expense ratio, and the entire fund is worth $69 billion, with the most recent dividend as 0.40. So what's good about these index funds is you're going to get a little bit of dividend with them, and that could differ. It may be monthly, it may be quarterly, it may be yearly, but you're always going to reap a little extra dividend along with that percentage you're making as well. And then on top of that, low fees and expenses. I want to talk quickly about this idea of beating the market. There is a segment of people out there who do not like index funds because they are not outperforming the market. They're only following the market. They're only doing what the market does. Well, as it turns out, over time, that would be a great thing. But there are a lot of investors out there that say, what do you mean? If the market's doing 10%, I want to do 50%. I want to do 500%. Yeah, that sounds great until you invest in something that's super risky and you're doing negative 500%. So that is the idea of the index fund, to follow the market, which is traditionally strong, and it's a great bet, a strong bet. There is a big thing with risk and reward. It's the more you risk, the more risk that you take, the higher reward you can get. And that's great. And when people have those experiences, it's amazing. It's like when you go to the casino and you pull on the arm of the one-armed bandit and you hit the jackpot and you're like, this is great. I'm going to hit the jackpot every time I come here. So you keep coming and you keep coming, and guess what? What happened to all those jackpots? It's like if you're a golfer, you hit that hole in one, you feel like Tiger Woods, you're the greatest. But how often does that hole in one come along? It doesn't, but it sure feels great when it does. There's something that I call the Joe Badger paradox. When you're younger and you're in your 20s, you really don't have a lot of money to invest. But that's the time you can be super risky and super aggressive with your investments and try to make those hole-in-ones and those jackpots. But the paradox is, normally, and this is not everybody, but normally you don't have a lot of money to begin with. So it's kind of tough. And then on the other end of the spectrum, when you're 60, 70 years old and you're settling into your retirement and your working days are behind you, you're not drawing in an income from work, that's when you typically, not everybody, but typically you have a lot more money, but you can't take huge risks even though you have a lot of money, because if you lose that money, it's done. So that's the paradox. And of course, this doesn't apply to everybody, but in general, it's pretty interesting. So the index fund is kind of like the safe bet, the thing that can help you invest money in the stock market, help your money to grow without taking on a lot of risk. And that could be for someone who's younger, or it could be someone who's older. So there you have it, guys and gals, a bunch of funny pronounced index funds that aren't going to be so funny when they're making you money. Ooh, can I write that down? Anyway, don't forget to subscribe. Don't forget to like this video, and that's going to help me out a lot. But I hope that these index fund recommendations are really useful for you. Remember, these are my recommendations. I would suggest that you research them a little deeper, make sure that you're comfortable with them, and then the allotment of money that you put into them, make sure it's not all your eggs in one basket. That's important. We have some principles on the channel. It's one, don't put all your eggs in one basket. 2, Rome wasn't built in a day, right? And 3, take profits. Make sure to lock in that money. But I hope you like this video. Thanks again. I'll see you guys next time. Joe Badger out.